Hello, I'm John Cogan, the CEO of Performative, the leading platform for professional development across the office of the CFO. I would like to welcome everyone to today's event entitled International Transfer Pricing, Core Issues and Best Practices. I'd like to thank our sponsor, Radius, whose commitment to thought leadership in this realm helps us make today's educational webinar possible and delivered at no cost to our participants. Complying with international transfer pricing guidelines is challenging at best. Today, more than 60 governments have adopted and vigorously enforced transfer pricing rules. Unfortunately, these regulations are not consistent across jurisdictions, and they are all constantly evolving. Today, our subject matter expert will provide valuable insight into the world of transfer pricing, exposing potential pitfalls and shedding light on how to improve your practices. Now, before we get to that, we've got a couple quick things to cover. Number one, learning objectives for today's event. We have a number of learning objectives. First, recognize your company's existing pricing obligations in the U.S. and other countries. Number two, assess and manage your transfer pricing risks. Number three, identify your company's transfer pricing approach. And number four, recognize ongoing transfer pricing development. So we certainly have plenty to cover. Let's get all of the logistical stuff out of the way. First, if you're interested in the slides, which are good slides, then you may find them and download them under the handouts area of your GoToWebinar control panel. To find that, you might have to hit the little blue flower-like object in your applications area, but it is right there towards the bottom of your control panel. You might have to hit plus next to the word handouts, and there's a PDF. Download it right now. Also, note that within the next 24 hours, we will send you an email, which will have A, a link to the presentation slides, and B, a link to the recording of the presentation, which we are making if you want to hear it all live. We are offering CPE for today's event. If you're interested in CPE, please answer all three polling questions and remain for the duration of the hour-long program. Your CPE credit will be awarded within 24 hours, and you'll find it in the My CPE zone of your profile. Please make sure you are logged into Performative when you go looking for that. If you're not logged in, you're not going to see it. If you have any questions at all about CPE, simply email us, cpe@performative.com. We would like this to be an interactive event. We have set some time aside at the end for Q&A. So please don't hesitate to ask questions. That is also in your GoToWebinar control panel. You can simply ask a question at any time. It's anonymized. No one will see who you are, and we'll do our best to get to your question. So feel free to hit us up anytime. Finally, at the tail end of the event, you will be presented with a short survey, and we greatly appreciate your taking the last minute to take that short survey. We're always trying to do better, and those survey results give us the feedback and input we need. So thanks in advance for giving us that last minute and providing your thoughts and feedback. We greatly appreciate it. Now, a quick welcome to Performative for first-timers and returnees alike. Thanks so much for joining us. We are the leading professional development resource for every member of the Office of the CFO. We have a massive online user community, over 2 million unique visitors a year. It's a great place to ask and answer questions. And of course, you're on one of our 200-plus live webinars a year, so thanks so much for joining us on this. We also have something that we call Performative Academy, which is this fantastic on-demand learning platform. There are almost 300 courses now. We add a course every day, plus or minus, and we provide CPE for 13 different certifications. So great learning on tap, 24/7, any device, fantastic. And it's also incredibly affordable. We're trying to just demolish all barriers for learning. So do check that out. All right, now on to the good stuff. This is the reason we're here, transfer pricing, core issues and best practices. And today we're going to hear from Lee Curthoys, corporate tax lead at Radius. Lee has over 8 years experience in UK and international tax, specializing in tax structuring for internationally expanding businesses, a key aspect of which is the efficient and supportable pricing of transactions between related entities. Lee is a member of the Institute of Chartered Accountants in England and Wales, and he has worked for a Big Four accountancy firm in the UK and in the Channel Islands. Lee, it is wonderful to have you with us here today. This is really interesting and very complex subject matter, and it's great to have someone with your depth of knowledge to help us find our way through. So thanks so much.
Thank you very much, John. Thank you for the introduction, and welcome to everyone. Good morning to those on the West Coast, good afternoon to those on the East Coast, and good evening to everyone anywhere else. So it's great to have you here. As John mentioned, I hope this isn't the first presentation that you've been on with Proformative and Radius. For those of you who are joining us for the first time, we'll be providing a brief introduction to transfer pricing. And for those of you who are returnees, hopefully this presentation will be a slightly more practical discussion than perhaps we've presented previously. So I hope that this is something new for everyone. As on the agenda there's a few areas that we're going through, and as I say, hopefully it will give you a practical insight into your transfer pricing responsibilities, and also give you some ideas on where you need to ask questions to those assisting you with it, whether that's internally or externally. So why is transfer pricing important? Well, there's a very simple diagram there. You have a US parent company, for example, that might sell goods or services to a related party in a lower tax jurisdiction, who then sells it on to the customers. Clearly, the IRS will want to understand how much profit is being recognised in that low tax jurisdiction, as opposed to how much profit is being repatriated to the US, particularly where you haven't gone through a check the box election and that profit is being kept offshore in perhaps a preferential tax jurisdiction. Why is it important now? Well, tax authorities have become increasingly aggressive in how they monitor how taxpayers charge for intercompany goods and services. There's a couple of reasons for this. There is clearly the financial crisis over the last 10 years or so, which has sharpened tax authorities' minds slightly on how much tax revenue, tax dollars, they are bringing in from their taxpayers. And therefore they have been investigating in much greater depth practices which perhaps as few as 5 years ago would have been considered normal commercial practice. We've gone from a phase of having a simple distinction between tax avoidance and tax evasion to now having aggressive tax avoidance, and tax avoidance which is not in the spirit of the law, even if it is within the meaning, within the written law. There's been a lot of publications around the activities of Amazon, Google, Starbucks, all household names which frankly 5 years ago their tax affairs wouldn't have been of any great interest to anyone, whereas nowadays it seems like a week doesn't go by when one of the tabloids doesn't have some news story on their tax practices. What's happened because of that? Well, governments have increasingly been working together to work out new ways to amend the global tax system, which has been in its present form really now for almost 100 years and hasn't kept pace with the 21st century international commerce, internet trading, cross-border transactions. The OECD, the Organization for Economic Cooperation and Development, have been working with governments to push forward the BEPS agenda, base erosion and profit shifting, which is very much a cross-jurisdictional approach to harmonizing tax systems and, as the name would suggest, ensuring that the tax base isn't being eroded in one country to the detriment of another. So, things to consider from having transfer pricing which perhaps isn't quite as robust as it should be. Well, there's the negative publicity we've already discussed, and it doesn't just apply to large companies like Google and Amazon, it can apply to any company of any size. Compliance, there's quite clearly some compliance costs to remaining on the right side of the transfer pricing rules, and there's also additional costs if you get onto the wrong side of those rules, not just in the compliance of getting back onto the right side, but potentially penalties for being there in the first place. It's important to be able to demonstrate your prices are at arm's length, and we'll discuss that in a little bit more detail later. Moving on to the next slide, just as a very basic introduction of what transfer pricing is. It's the price at which one entity sells goods or services to a related party, or otherwise shares group costs. What's an associated entity? Associated enterprise, I beg your pardon. It is an entity which is under common control of another entity or is controlled by that entity. The key principle in transfer pricing is the arm's length standard. You must be able to demonstrate that the prices you are charging to your related party are what prices would be charged between unconnected entities, the so-called arm's length rule. How do you work that out? Well, you look at the functions, assets and risks that are involved in providing those services or selling those goods, and you compare those functions, assets and risks to those which you would see in an unconnected transaction. So, as we mentioned there, it's essential to limit the risk of economic double taxation. The risk here is that if you recognise profits in one jurisdiction, you'll be taxed on those profits. If those profits are adjusted because they're not on an arm's length term, those profits might go up in one jurisdiction, but you may not find that there's an equivalent deduction in another jurisdiction, and therefore those profits are taxed twice. There are treaty remedies against this double taxation, but in the absence of having sufficient transfer pricing documentation, it may prove difficult to obtain those treaty remedies. For example, tax authorities will frequently provide a mutual agreement procedure whereby they will discuss with the other tax authority what the appropriate profits to be recognised in one jurisdiction over the other should be. Where taxpayers seem to be uncooperative or perhaps unwilling to support themselves through holding sufficient documentation, those tax authorities may be similarly unwilling to provide support as well. In addition, treaty remedies are quite often time-consuming to implement, and obviously where time is involved, cost is also involved. So it's important to ensure you have adequate documentation in place at the time that the transactions are being undertaken to avoid having to support yourself later on.
All right. I believe this brings us to our first polling question, Lee, so I'm going to go ahead and launch that straight away. This is the first of 3 polling questions. I will leave all polling questions out for 30 seconds or so to give everyone plenty of time. This is obviously really a quick and easy one. We love everyone to participate. This is not a test. This helps us and Lee specifically understand who's in the audience, and that helps him tailor his content, and we will actually share out the aggregated data. Your specific answer is completely anonymous here, so don't worry about that. But it's frequently very interesting to know what your compatriots on the webinar are doing in this area. So we'll get a quick look at that. I'm going to go ahead and close this down now. Let's share out the results and see what we've got. The question is, have you had a transfer pricing report prepared in the past? And Lee, what do you think about this spread of answers here?
Yeah, it's a very good spread of answers, actually. I think it's not uncommon for companies to have not really given this a huge amount of thought, so the slight number of no's in excess of yeses doesn't come as a great surprise to me, particularly where companies are just moving into the global marketplace beyond their home shores, so that doesn't surprise me at all. So, moving on from there, in terms of having transfer pricing reports prepared, I think it's useful to give some thought to what the documentation should look like in order for you to remain compliant. And there's 2 real pieces of documentation which every company should have in place. And they're the intercompany service agreement and the benchmarking study. In addition, a lot of taxpayers give consideration to what's commonly known as safe harbours. What rate can we use where the tax authorities won't inquire into us? I think it's important to say right away that that only provides limited protection. and certainly doesn't replace an intercompany service agreement and a benchmarking study. So we'll go on now to consider what those intercompany service agreements and benchmarking studies look like. So the intercompany service agreement is the contract which is akin to that between independent entities. It really is the document which describes each entity's rights, responsibilities and roles in regards to the goods and services which are being provided within the group. As such, it should contain the standard elements that you would expect to see in a third-party document. So price, for example, termination clauses, etc. The intercompany service agreement is important because it can demonstrate that one entity is acting within its remit in a particular jurisdiction, and therefore it reduces the risk of the other entity having what's called a taxable permanent establishment in that country. Effectively, it ring fences what activities may be taxed in that country. What it doesn't do is mitigate the risk of the transfer pricing being challenged. And for that, it's very important to have a benchmarking study. So the intercompany service agreement, as I say, it documents a price to be charged, but doesn't support their arm's length basis. So on the next slide, we talk about the benchmarking study. This is a key document. As I mentioned, for intercompany service agreements, this gives the parameters for each entity to provide goods or services to the other. The benchmarking study is the means for demonstrating that the prices for those goods and services are what one independent entity would charge to another. It looks at various details, including what the entities are doing, what are the relevant transactions, which may seem obvious but can actually be rather more complicated when you drill down to it. And it also considers what the functions, assets and risks are. So what is one entity doing, what assets are they employing, and what risks are they undertaking in providing those services. And clearly, the more functions they're providing, the more assets they're using, and the more risks they're encountering, the higher return you would expect to see for those services. The process for preparing a benchmarking study is a manual process. You typically start off with looking at a number of different companies performing similar services, and you have to cut through that number of companies to work out a core population which are doing very similar services or providing goods similar to what your company is doing. This means, unfortunately, that benchmarking studies can be rather time-consuming, and as I mentioned previously, can be rather costly. For many of people obtaining a benchmarking study for the first time, the cost can be slightly surprising, particularly if you're speaking to one of the big four. But it's important to weigh up the cost-benefit analysis of obtaining a benchmarking study rather than simply putting a finger in the air to determine what the rate should be. For example, a very basic example of the potential costs here would be if you have $500,000 of costs in a jurisdiction and you're not charging a markup on those. The tax authority might come along and say, you know, hey, actually a 10% markup would be appropriate, and therefore you have $50,000 of profits in a jurisdiction, taxed at 30%, $15,000. Typically benchmarking studies valuable for about 3 years before you need to have them reviewed. Different countries have different rules on that. So you're looking at a potential risk there of $45,000, which is just on $500,000 of costs. So you can quickly see that the risks can mount up, and very quickly the costs of obtaining the benchmarking study can actually look very effective relative to those risks. Next slide, please, John. So when do you need this documentation in place? Well, the requirements vary country by country. Generally, you have to have documentation up to date, And as I mentioned before, some countries are very prescriptive in when that documentation needs to be refreshed. The timings to provide documentation might be very tight. Quite often we see tax authorities requesting information and giving a 30-day turnaround period, while if a letter takes a week to come through the post from the tax authority, that only leaves you with 3 weeks. And as I mentioned previously, a benchmarking study can be a time-consuming exercise to prepare. So it's better to have the documentation in place at the time the transactions are undertaken, rather than trying to put it in place later, potentially under time pressures. The other issue with not having documentation in place at the time and not being able to present it when required is that that may cause good standing issues with your local tax authority. This could give rise to additional issues such as more tax audits and less cooperation. So how do you determine what appropriate transfer price should be? Well, there's a number of methods depending on the country, and typically they follow a typical pattern, whether you're looking at the US transfer pricing methods or the OECD models, which are more commonly used outside of the United States. The CUP method, comparable uncontrolled price method, is very common, particularly for goods where there's identical or very similar transactions with third parties. That's not so appropriate where you have an unusual transaction which isn't also being provided to a third party, such as sales and marketing activities, which is what many companies do when they first dip their toe in the international marketplace. Where you do have sales and marketing services being provided, quite often the appropriate pricing system is the comparable profits method, as it's known in the US, or the very similar transactional net margin method, as it's known elsewhere, which is more suitable for services. There's a couple of other issues to consider on the next slide. You have Commissionaire arrangements, particularly common in EU countries. However, it's worth saying that whereas Commissionaire arrangements have been fairly standard for many years, with the BEPS initiative, which I mentioned earlier, these are changing, and therefore it's not appropriate to rest on one's laurels in terms of how these arrangements are priced. They don't provide the limited PE risk, permanent establishment risk, which they may once have done. Similarly, the Commissionaire arrangement in EU countries is less common in the US, Canada and UK, and therefore you stand the risk of having an agency relationship whereby you have a greater risk of having a taxable permanent establishment in the country in which the other entity is acting on your behalf. So what common scenarios do we see for pricing intercompany transactions? Well, as I mentioned before, sales and marketing activities are frequently priced on a cost-plus basis, where all of the costs of the activities are pooled together and a markup is attached to that. That markup can be calculated a number of different ways, and as I mentioned, the comparable profits method or transactional net margin method is the most common. Net margin is particularly useful for administrative or management support activities, whereas for physical goods, the comparable and controlled price method is common. As well as the activities which are provided intercompany, you may also find that your subsidiary is making direct sales to a local entity, in which case you need to consider how the goods or services which are being provided from the parent to the subsidiary should be priced, because clearly revenue will be going in the opposite direction for those services. As I mentioned earlier, a lot of people consider a safe harbour rate may be appropriate. Some countries do have safe harbour rates, Brazil being a common one. Often unofficial safe harbour rates do exist, so our clients at Radius frequently ask us, we've got a new sales and marketing entity, what markup should we apply? Commonly, a safe harbour rate for such an activity is 5 to 10%, but it varies throughout the world, and while you may decide to use a rate within that range, applying a rate within that range may reduce the likelihood of being picked for an audit because your profits don't stand out from the crowd. However, they're not a substitute for a full benchmarking study, and therefore if you are picked for an audit, the safe harbours aren't a defence, and therefore you may still incur penalties or adjustments if you cannot support those prices. So moving on to the next slide. As I mentioned previously, in order to determine whether a transaction is on an arm's length, you would typically look at the prices charged between unconnected entities, and therefore what that arm's length price would be. What would a third party pay for the same goods and services, and is the price quote unquote fair for those goods and services? In addition, as I mentioned, you would look for similar entities performing similar transactions. However, as we know frequently in the real world, there are not completely identical transactions, and therefore there may need to be some adjustments to take into account the particular factors underpinning the transactions. The contractual terms, for example, will be economic conditions in the specific country in which that business is operating, and therefore as part of a benchmarking study you may include certain commercial practices adjustments in order to reach a sensible pricing for those goods and services. As we mentioned previously, the OECD is taking the lead role internationally on trying to resolve what is a frankly outdated and unsuitable international tax landscape. And there's been two real outputs which really affects organisations from the OECD's BEPS initiative. The first one is country-by-country reporting. This is where you have a file of documentation which you provide to the different tax authorities, whereby they can see which profits are being attributed to which entities around the globe. This is quite a new idea. Previously, tax authorities would only have been interested in what was happening in their country, and indeed, under many local tax laws, may have only have had a right to inquire into what was happening in their local country. Whereas the country-by-country reporting provides tax authorities with a means for seeing how the overall group looks. And coupled with this is the increased prevalence of exchange of information agreements between countries, which allow tax authorities to share that information on their national and foreign taxpayers. The second key output from the BEPS initiative is the master and local file for transfer pricing purposes. This has already been enacted by Spain, Australia and Singapore, and it really takes a holistic view of what the overall group looks like in terms of which entities are doing what in the group, how the supply chain operates, where the value is being added in the whole worldwide group. The master and local file does exactly what it says on the tin. You have a master file which is held at the parent company's location, which documents the whole of the group's activities. You then may have a local file in the local jurisdiction which documents what the specific local entity is doing. However, frequently the tax authorities in the local jurisdiction will also expect to see a copy of the master file, so as I mentioned before, they can have an overall view of the group and where the profit is being generated and where it is, perhaps more importantly, being taxed. The one thing to say about the BEPS initiative is that it is supported by national governments, but it is not a requirement of those national governments, and the OECD has no jurisdiction over national governments, and therefore over the next couple of years we can expect to see the outputs from the BEPS initiative being implemented in a perhaps slightly ad hoc fashion in different countries, really quite a pick and mix type approach. And any such amendments do need to be enacted in the local domestic legislation. Similarly, where a amendment impacts a tax treaty, at the moment tax treaties are completed on a bilateral basis, and therefore if a country decided to amend its tax treaties, it would need to go out to each individual other country with which it has a treaty. The OECD is looking to amend this by introducing a multinational standard whereby where one amendment is made, it can be rolled out to all other countries with which that has a treaty. So watch that space in that respect. It may become increasingly easy for governments to make such amendments which previously would have taken years, if not decades, to implement. So why is transfer pricing a real issue for business and not just something for your tax department to worry about? Well, perhaps the most famous example of transfer pricing becoming an issue in the real world was for GlaxoSmithKline, the pharmaceutical giant. Back in 2006, they reached an agreement with the IRS under which GSK would pay $3.4 billion to the IRS to resolve transfer pricing disputes which have been running for 16 years. Clearly, $3.4 billion is a significant sum of money to any organisation, perhaps less so to such a huge organisation as GSK, but it does bring into focus the fact that transfer pricing can have a serious effect on an organisation. Looking at perhaps a more real-world example, certainly for many of Radius's clients, we had a client which had a sales and marketing subsidiary in Singapore. The client was a food business, and unlike most sales and marketing subsidiaries, because they were a food business, they had quite a large fixed asset base, kitchen equipment, etc. The Singapore tax authorities had a look at this and determined that their balance sheet appeared unusual compared to what a normal sales and marketing subsidiary would look like, and therefore they decided to open an audit into that client. They gave the client 3 months to provide the documentation, and under those circumstances, Radius was able to prepare a transfer pricing study for that client, which fortunately, and this doesn't always happen, but in this case, very fortunately, it did support the existing pricing, and the audit was closed. That's a good news story. Unfortunately, the Singapore tax authorities have recently amended their rules, and documentation must now be available at the time that the tax return is submitted. In practice, they give 30 days, but as I mentioned, by the time the letter comes through the post, you may only have 3 weeks, and a transfer pricing benchmarking study is a time-consuming exercise. Therefore, in similar circumstances today, I would be very concerned about being able to meet that deadline and therefore avoid incurring penalties from the Singapore tax authorities. Similarly, by acting in advance of any transfer pricing audit, you can include adjustments in the tax return. However, these do tend to be one-sided, and therefore, even without a tax audit being undertaken, you may find that you are showing additional profits in one country without a similar deduction in another. leaving yourself at a disadvantage. So it's always preferable to ensure you have your documentation in place at the start, so that your pricing is reasonable from the start and is therefore less likely to suffer challenges later. And at that point, John, I'll hand it over to you for our second polling question.
Great. I actually have a quick question for you, just under clarification. When you say the rules in Singapore mean that documentation must be available immediately, like how immediately is immediately?
Very good question. So the rules in Singapore say that you must have contemporaneous documentation. So when you submit your tax return, by law, you should have your documentation in place at that point. Obviously, when a tax audit is initiated, they will request information and they will expect it to be provided in a timely manner. A timely manner is typically 30 days, and therefore, as I mentioned, you might have a week of a letter winging its way through the post to you, so you've got effectively 3 weeks to prepare that documentation and provide it to the tax authorities. 3 weeks is a very tight turnaround for documentation, and as I mentioned, in any case, that documentation may not actually support your existing pricing, and therefore you may have adjustments even if you do manage to get that documentation in place within the time frame.
Gotcha. Great. Thank you for that. All right. Second polling question coming up, folks. Launching right now, and we'll give this 30 seconds as we did last time. The question is, does your company have locally compliant employment contracts in the regions where your company conducts business? So speaking of things international, another complex area, we will leave that open for another 10 seconds or so. I'll remind folks that they can ask questions at any time. We'll do our best to get to them during the Q&A portion, which is coming up. We've got some questions already queued up. Thank you for that. And feel free to add as we go. We've got a great expert here to answer all your questions. All right, I'm going to go ahead and close down this poll, and as we did last time, we'll share out the results.
Does your company have locally compliant employment contracts? Well, it's great to see that the vast majority say yes. Yes, and no is definitely in the minority, which is reassuring. I think it's important to have locally compliant employment contracts because there are some quirky rules which do affect your exposure to taxes in different locations for not having those locally compliant contracts. For example, in France and Belgium, you are by law required to reimburse employees' home office costs, which can be easily missed. The problem is with having reimbursement of home office costs, that can create a permanent establishment exposure, which can lead to additional profits being taxed in those countries and transfer pricing risks. So it's really important to speak to a local HR professional or a firm such as Radius, which has local professionals that can assist you to ensure your contracts are appropriate in each national jurisdiction, and it can reduce your risk and help you save potential tax costs in the long run. So, as I mentioned at the start of this webinar, this is really intended to be perhaps a slightly more practical approach than some of the webinars we've hosted previously. And so I think it's important to perhaps ask yourself some questions when you are looking at your transfer pricing, particularly where you are expanding overseas for the first time. So what countries are involved? What is your global net? Is it expanding, for example? It's very important to get your transfer pricing right from a global perspective from the start, which will enable you to be an effective global organization. What activities and functions will be performed in the country? Again, I come back to the question of where is the value being generated in your organization, and therefore where should that value be recognized as profit and taxed accordingly. What assets are used and where and what risks are assumed in country, and also who will be employed or who will provide services in your newly established entity overseas. As I mentioned, what assets are used, what risks, and what employees do you have in that country. All of these things may indicate that you have a bigger footprint in that country. And with a bigger footprint comes a greater likelihood of your entity in that country being spotted and reviewed by the local tax authority. It's much better to stay under the radar, but equally, if you do appear above the radar, you need to ensure that your documentation is in place so that you can defend yourself if necessary. What contracts will exist with your newly established overseas entity? By that we mean, what will your revenue model look like? Will that entity have contracts with third parties? So would a direct revenue model be most appropriate? Or will it really be providing services only to other group companies, and therefore perhaps a cost plus model may be more appropriate? And if it is a cost plus model, what should that plus on the costs be? And finally, how will your newly formed overseas entity be financed? Will you be subscribing a significant amount of share capital into that entity, or will you be loaning that entity money? Do you need to think about thin capitalization? By this we mean where you have a greater amount of debt than equity. As you may be aware, debt incurs interest which is generally tax deductible, whereas equity pays dividends which isn't tax deductible, and therefore tax authorities may look at the interest deductions which are being claimed and decide that those are excessive. How do you price intercompany debt? Should it be based on the overall group cost of the debt? Not necessarily in most cases. What you should really be looking at is what would that debt cost to that entity if it was acting in a completely standalone capacity, and that debt should be priced accordingly. These are issues which we frequently see our clients not giving a huge amount of consideration to, and which can accordingly cause problems later on. So once again, I repeat the mantra that it's better to get these things right from the start than try and fix them later. So where you have a in-house tax department or a professional advisor giving you support on your transfer pricing study, what kind of questions should you ask them? Well, typical examples might be, why have we chosen that markup? On what basis? And a good transfer pricing study should show a broad selection of similar entities and also entities which have been ruled out as being dissimilar. How do we compare this to an arm's length price? So what methods have been used to determine whether that rate is reasonable? How many years worth of profits have been looked at in those other companies? What is my audit assessment risk? How likely is it for the tax authority to come knocking on my door? And how often should I review my documentation, my policies, my intercompany service agreement, and my benchmarking studies? As I say, different countries have different rules. India requires a benchmarking study to be updated annually. Most countries are slightly more relaxed about that, and they'll generally see a benchmarking study being suitable for 3 years. Of course, that assumes that the nature of the transactions, how large the company is, doesn't change in those 3 years. And clearly, if you've got a rapidly growing, rapidly developing business, then a benchmarking study may become redundant within 1 year. and therefore it's important to keep an eye on what your business is doing, what additional functions might be carried out. So quite often we see a company going in as a sales and marketing role only, and then after a couple of years they might start providing technical support. And clearly with technical support, that has a slightly different functions, asset and risk profile than a pure sales and marketing entity. And as I mentioned previously, whether you have more functions, more assets and more risks, typically you would expect to see a higher return on those attributes. So just in summary then, why is transfer pricing important? Well, the risks are that you might have outdated or no documentation, and in those circumstances the tax authorities might look unfavourably on your transfer pricing and assess you for adjustments, which, if you've got no evidence to support the initial price, the tax authority may be less open to negotiation around any adjustments they come up with. As I mentioned before, companies may grow and evolve away from their current documentation, particularly for many of the high growth companies that we do business with. And also, why should smaller companies worry about this when tax authorities can go out to GSK and get $3.4 billion? Well, quite simply, GSK, Amazon, Google and Starbucks can afford to pay an army of lawyers to fight their case for them, whereas many smaller businesses, startup businesses, businesses which are just expanding abroad for the first time, may not have those financial resources to be able to fight back against a tax authority challenge, or perhaps more appropriately, their resources may be better spent doing value-added activities within their business, growing their business rather than fighting these tax authority challenges. And therefore, tax authorities may see smaller businesses as an easier target. They can go in and make a higher adjustment with less pushback. So it's important to be able to demonstrate from the start that your prices are reasonable. And generally, if a tax authority comes knocking at your door and asks for documentation, and you can provide documentation in a timely manner, those tax authorities will be grateful and may just go away, which is fundamentally what most taxpayers would prefer. What's the consequences of not having sufficient documentation? Well, as I mentioned, penalties and interest for incorrect returns. Most returns require you to state that your prices are on an arm's length basis, and therefore if the tax authorities decide that they're not, you can be penalised for submitting a return on that basis. Even if the tax authorities don't find any adjustments required, you can incur penalties for having no or insufficient documentation, which is quite a new thing, to be honest. That's really only happened in the last few years, but as well as being unable to prove that your prices are reasonable, simply not having the documentation to prove it in the first place can incur penalties. And finally, as I mentioned, you might have a one-sided tax audit adjustment. So you may have to have additional profits taxed in one country with no corresponding deduction in another country, and therefore you're being taxed on that income twice. And on that point, I think I'll hand back to John. Thank you everyone for listening.
Wonderful. Great information there, Lee. Thanks so much for that. But we are not done yet, folks. We have some time for Q&A. And, well, we have some questions here, coincidentally. So, Lee, let's go ahead and start firing away at you here. So you were just talking on that last slide about issues of not having proper documentation, et cetera, and companies of all sizes. Are there any parameters that allow you to not have to do all of this stuff? Is there a threshold below which your revenue is just so small people don't care, or your company activity is so small that the taxing authorities aren't going to pay attention to you? Are there any outs here?
There are thresholds in different countries. Unsurprisingly, those thresholds vary depending on which country you're looking at. So for India, the threshold for documentation is 10 million rupees, which is about £100,000 or $150,000, so that's relatively low. The UK has a rule for small and medium-sized entities which don't require documentation in place at the time the tax return is being submitted. For a small or medium-sized entity is defined as a company which in the whole worldwide group has less than 250 employees or less than 40 million euros of turnover or balance sheet size. So those are fairly high numbers, certainly relative to the numbers I just mentioned in India. Generally, I would say that thresholds are the exception rather than the rule. I think it's important to have that documentation in place, not only to support the pricing, but also, as I mentioned at the start, regarding intercompany service agreements, to set out the parameters that one entity is operating in relative to an overseas entity, and therefore it makes it a lot more difficult for a tax authority to try and pin the profits which are being realised in another part of a group to the local entity where you have an intercompany service agreement in place. So while there are thresholds in certain countries, and I would repeat that they're not in all countries, I think it's important to look at your overall worldwide group to determine whether there are risks as a whole, and it may be rather more economical to try and address those risks on a global basis rather than on a country-by-country basis.
Gotcha. Great. Next question. There are a number of legal entity types that companies might engage in order to expand overseas. And then there are things like independent reps that you might sell through. Where's the threshold between the company owns and controls this entity in another country versus having no control, and kind of where do you tip from having to deal with transfer pricing and all of the overhead you've been talking about versus not?
Yeah, that's a very good question. So it really comes down to the independence of the entity which is providing those services to you. Where an individual or company is acting on an independent basis, then generally you don't need to worry about transfer pricing, because the arm's length standard, which I mentioned previously, should apply automatically where you are dealing with a third party. How do you determine whether an entity is independent or dependent? Well, you need to look at a number of different things. So, does that entity provide similar services to a number of different entities? Could that entity survive if suddenly it ceased selling its goods and services to the other entity? What risks does that entity entail? So, for example, if you've got the selling entity, the representative that you mentioned before, John, do they have any requirements to see out the fulfillment of orders after they've been placed, or do they simply take the order and then provide it to the overseas entity, which is then responsible for fulfilling those orders. So, as I say, it really depends on just how independent that entity is. And as I say, if it's not independent, then you have two issues you need to think about. First of all, how much you're paying that entity for transfer pricing, and also potentially, is that entity acting as an agent for you in that country, and therefore creating a taxable permanent establishment in that country, which the tax authorities there could try to pin some profits to and tax accordingly.
Gotcha. We have time for one more quick answer on this question. Do you think the trend in countries like China, India, Brazil, and others who are making increasing investments in transfer pricing audit resources, which is to say audits are becoming more frequent, more common, do you think that trend is only going to continue?
Yeah, I think it will. I think it will. As I mentioned earlier, tax authorities around the world are under a squeeze at the moment because they have reduced tax revenues. You know, global growth is not what it was 10 years ago, and therefore their tax revenues are similarly failing to grow, whereas their healthcare budgets, defence budgets are still growing. And therefore tax authorities will look at any means to increase their tax revenues, and certainly employing more sophisticated means, and I'd certainly consider transfer pricing audits to be a sophisticated means of obtaining more tax dollars. Certainly tax authorities are looking at ways of doing that to maximise their efficiencies and effectiveness.
Gotcha. Wonderful. Hey, Lee, we have a number of questions we simply don't have time to get to. Can we work with you afterwards to perhaps get some of these posted out in the performative community and let everyone benefit from some answers to those questions as well?
Yes, absolutely. Please send them over and we'll respond to them.
Thank you, and I do apologize, folks. There are a lot of great questions. We just don't have enough time for all of that. Okay, well, let's work to get everyone out on time. First off, Lee, great job today. I've had a number of folks comment, great presentation, and I agree, so thank you so much for that.
Thank you very much, John, and thank you to Proformative for giving Radius the opportunity to present this. And thank you, everyone, for listening in.
Our pleasure. Folks, please do join us at performative.com to continue the conversation with your peers in our community and also to see what Lee has to say about these other questions. If you want an introduction to Lee or to our sponsor, Radius, please tell us on the post-event survey, which is coming your way very soon. We're going to have one more polling question in just a moment. Of course, thanks again to our sponsor, Radius, whose commitment to thought leadership in this realm helped us make today's educational webinar possible and delivered at no cost to the participants. Radius, big supporter of what we do here at Performative, which is trying to make learning and thus life way easier for folks in the office of the CFO. I am now launching the third and final polling question. You should see that out on screens, and under what kind of revenue model does your company operate? Once again, this is just to understand where folks are coming from here. And while you're taking this, I'm going to take the opportunity to thank everyone for joining us today. We appreciate how busy you are, and it's great to have you joining us and all learning together. It's a fantastic thing. So welcome, and we hope to see you again on another Performative event or online at performative.com. At this point, I'm going to go ahead and close down this final polling question, and we will bid everyone adieu. The post-event survey is coming up right now. Thanks, everyone. Have a great short rest of your week, and hope to see you soon. Cheers.